do pop up that you don't see or don't foresee. And there should be some sort of metric or thing that helps people understand what that risk is, because especially newer people, it's very tough to understand that and wrap your head around it without the experience like somebody that you has.
Well, here's how you do it. It's very simple. When you are looking at your numbers and you're budgeting your numbers, or you're laying out a pro forma, and you guys know this, you will budget a vacancy allowance, or what some people call vacancy factor. That could be, I use 5% as a default, and then I adjust up or down depending on the location and the type of property. Mm-hmm. But generally speaking, you're going to budget between 4% to 8% of your gross rental income as a vacancy allowance, which means that you are expecting a vacancy. You're going to have a turnover where you're losing a good month, a full month of rent, maybe more, but you budget 5%. If you're budgeting 6%, you're basically saying 1 month per year. If it's a lower end area, you budget a little higher. If you know the area through your own research, or your property manager saying, hey, this area has higher turnover, there's just more transient people in this area, budget higher. But you have vacancy allowance built in. Now, granted, you may not spend that this year or even next year, but you factored it in because you know it's going to happen, and you're prepared for it. And that cost is not going to affect you because you've already accounted for it. Mm-hmm. And the other big one is repairs and maintenance. You have to have a 5% repair and maintenance budget, if you will. Now, again, that could be from 4% to 8%, maybe 10% if your property is older and repairs and upgrades haven't been done in a long, long time, and that carpet replacement's coming up or something like that, you adjust it. But I would say put a minimum of 5% as repairs and maintenance. And you know what? At the end of the month, that's going into your bank account. At the end of the year, if you haven't had a vacancy or any kind of repair, that's all sitting in your bank account. But you've earmarked it for that turnover or mm-hmm. for that repair. So when you do that, and those are soft costs that you budget, but when you do that and you still have positive cash flow, guess what? You've got a good investment because you are making a rate of return, you've got positive cash flow, and you've already factored in for these events that will happen at some point in time. That's the way to your point, what's your discounted return? That is your discounted return. You've already budgeted in for those events that will happen. It's not a matter of if, but when.
Mm-hmm. Now the key when someone does that is if you take the money out of the bank and take the bank account to zero, then if you have a problem, you realize you have to put more money in. So, a prudent investor, or what do you want to call, maybe less risk, more risk adverse or whatever it is, you got to keep some operating money in the account, right? Now, if it's your own house and it's you and it's just yourself, that's the investor, and you run it, a little, separate bank account or through your own, that's fine. But if you take all your money out and you're cash flowing $400 a month, that's great with vacancy factored in, because if it's not vacant, you'll have more money. You just got to have the wherewithal to say, okay, if something goes wrong, my money's either there, but you can't just spend it. Because if you spend it, then you're, discount factor or not, there's no money left in the account. So you have to be aware of that. So when those rainy days do come, you're able to fix issues and it doesn't cost you any money. And that's where I think a lot of people miss it or miss the boat. If your vacancy is right, you have an extra $1,000 in the bank. That doesn't mean you made more money. It just means you made more money. You either leave it there or you know that you're going to have to put it back in at some point.
Yeah, my rule of thumb for that is if you're just starting out and you're buying your first property, make sure you have 3 to 4 months of gross rent in your bank account as operating capital. That's just what you're sitting on, and you use it if you need it. And then as you grow your portfolio, then you scale that back. You don't need 3 or 4 months worth. You can scale that back to 2 to 3 months, and then ultimately 2 months worth. And then if you have it depends on how you structure your entities, but if you have 10 or more properties, maybe you only need about 1 month's worth of gross rent per property, because you're not going to have a vacancy at the same time. You're not going to have repairs all happening at the same time. You've got this, slush fund, if you will, of $10,000 of operating capital across 10 properties, and you just tap into it when you need it. But yeah, don't leave the account dry like you're talking about, with zero in it, because then if something happens, you're caught with your shorts down. Now what do you do? Well, you're going to have to borrow from Peter to pay Paul, and that's not fun.
No.
So.
Yeah, I think it's important. A lot of people, when they're buying a property, don't even think about having those reserves up front as something to keep in the account. It's just, hey, what's the bare minimum I need to get this deal done? And I just think you're setting yourself up for failure. Not having reserves in place is, I just think that one of the dumbest things you can do. And then the other thing people always ask is, how many reserves do I have? And I think it's a good rule of thumb, but I think also what are you comfortable with at the end of the day? Like one, don't go crazy because the deal has to make sense. But two, what are you comfortable with? And the other thing too, if you go high and the deal is doing well and you're like, hey, we can, cut back a little bit, and you just distribute it, whether it's to investors or yourself. It's just money there. So, anybody listening should definitely have reserves in place for any property you close. I do have a question though, because I've had this conversation with other people. As you build up a portfolio by yourself of single family homes or smaller properties, do you recommend having a reserve account for each property? Do you say have a certain amount in your personal account per each property? Or is there just a total number that you think people should have? How do you feel about that? As people have those reserves?
Well, you should treat your rental portfolio as a business. So it's separate from you. First of all, never hold title in your own personal name, always hold title separately in an entity like an LLC. That's the most favored entity that investors use for asset protection purposes. If you're doing that, then your LLCs have their own bank account because you have to have complete separation. So it's not just the entity, but you have to have its own set of books and its own bank account. If you do that, then you can store that capital for reserves within the bank account for that entity. Now, you're opening up kind of a can of worms because you're actually opening up the question of, well, how do I structure my entities to hold my properties? How many, properties do I hold in each entity? Do I have one LLC per property, or do I have one LLC to hold, 3 to 5, or how do I structure that? And that's a separate question. But you definitely need the reserves. You have them in the bank account that's attached to the LLC. Generally speaking, I'm not an attorney, and this is not legal advice, but generally speaking, you'll want your entity to be in the state where you have the properties. And then the question, you'll get 10 different answers from 10 different attorneys, but you can have anywhere from 1 or more properties per LLC. I think it's not unreasonable, but extreme to have 1 property per LLC. Keep in mind, LLCs are very, very inexpensive. It's really the cost of your you have a filing fee every year, could be anywhere from $50, $30 to $150. And then you have your resident agent fee, which is $100 and some per year. So think of it as like insurance. It's just a cost of doing business. So it's not expensive. But the question is, how many LLCs do you want for your properties? And there's different schools of thought on that. But the short answer to your question about having reserves, yes, you need them. Yes, you want them in an account, not your personal account. You want them in your business account. And of course, the revenues that are coming in from your properties that are being deposited into your bank account from your property management company are going into that LLC account. That's where you store your operating capital. And that's where you decide whether you need, $2,000, $3,000, $10,000 worth of reserves, depending on how many properties you're holding in that LLC. I don't suggest you have a whole bunch of properties in one LLC from an asset protection perspective, because you get in trouble with one property and all of a sudden it does become a lawsuit and there's a judgment and they attach it to your LLC. Now it's really attached to all those properties because when you liquidate one and you have a gain, it's going to go through that LLC and the judgment is there. So, it gets a little more complicated, but that's the gist of it is, yeah, you need it, but keep it separate. Gotcha.
No, I think it's a great answer. I do think the one thing I'm going to do is I'm going to push back a little bit because I worry, and I've talked to new people, they get so caught up on the asset protection, the structure, the LLC and stuff like that. Guys, if you're getting started, you don't have millions of dollars of assets, you're working on your first or second property, don't get caught up on how it's structured, what LLC and what state and whatever. Work with your attorney, figure it out. Don't get caught up on the structure and the asset protection if it's going to prevent you from doing a deal. It's definitely important. Definitely talk about it, continue to work on it, make it better, but don't allow that to stop you from buying a deal. It's the same thing as analysis paralysis. Don't get caught up too much in the numbers. You got to do it. You got to learn it. It's the stuff you got to do, but don't allow it to keep you from buying a property. So awesome information. I agree with everything you said. I think it's a great place to get started. I do worry that just somebody listening might take that as like, oh, I've got to go figure this all out before I get started. Don't. Go get started, work with an attorney, but don't let it hold you up.
Well, I'm just going to add one more thing to that, because Chris, I've heard that so many times where people have been, I think it's just an excuse personally, but people have held back buying their first property. Often it's the first one, but many times it's the next one, because they have to get all their ducks in a row. And they're thinking, well, I got to figure out, what kind of entity and what state it should be in, and I need to have that set up. And they make this big deal out of something that is so simple. I mean, you could literally, if you don't have an attorney, you could literally set up anonymously an LLC online, through different services, where you have that entity set up before, during, or after your purchase. The thing is you're putting the cart in front of the horse. Damn it, just buy that property with the right team of people working with you and for you. Get that asset. You can transfer that asset to an LLC anytime you want. There's no tax implication. There's no negative to that. All you're doing is you're taking your property and putting it into your entity at some point in time. I like to do it the same day I close escrow when I buy property. I mean, literally it happens 5 minutes later because you already got the documents signed. So they close and then transfer. But if you're holding yourself back because of that, that's pretty bad. That's not a good reason to hold yourself back. Find the right property, make a smart investment choice, buy it, and then put it into an entity. I mean, you can worry about that anytime you want, but just start investing or get that next property.